Welcome to this talk on the future of funds, where we'll explore how a changing economic landscape is reshaping strategy and operations. Over the next slides, I'll outline the key market forces, technological levers, and practical actions FOFs can take to stay competitive, scale smarter, and capture new sources of return in a more dynamic environment. In this slide, we see the great inflection. AI adoption is expanding beyond hyperscalers into enterprise applications. US growth is re-accelerating. Capital is rotating into emerging sectors, and legacy static allocation approaches are giving way to dynamic engines. Put together, these trends demand real-time adaptation and illustrate why traditional FOF playbooks need to evolve toward more responsive, data-driven allocation. This diagram shows an integrated intelligence platform for FOFs that consolidates GP interactions, cash flow models, and third-party data into a single source of truth. From there, AI summarizes diligence into auto-tagged insights, surfacing emerging manager skill before quarterly reports arrive, which improves selection speed and decision quality while reducing manual work and enhancing transparency across the portfolio. Scenario modeling layers capital calls and distributions through a scenario engine to optimize deployment timing. The output helps pace commitments predictively, reduce cash drag and idle capital, and strengthen negotiation positions for co-invests by aligning funding certainty with managers' needs. In short, this approach turns uncertain cash dynamics into a strategic lever for higher IRR and better terms. Here we map market drivers to FOF responses. Public market concentration is pushing institutional capital toward private credit, infrastructure, and hybrid vehicles, creating dispersion and new leadership zones. The practical response for FOFs is blended structures and semi-liquid sleeves that balance access to early growth vintages with target volatility controls, enabling participation in new growth while managing liquidity and risk. This slide highlights a tactical window where European small-cap earnings are poised to benefit from German fiscal stimulus, energy transition capex, and defense rearmament, offering a lift to Eurozone small-cap EPS. For FOFs, that can justify swapping some US megatech exposure for Eurozone value and income, capturing a lower peg, higher forecast growth opportunity in a targeted overweight strategy. Regulatory complexity is multiplying with tokenization, new AI valuation models, and cross-border distribution, increasing compliance friction and operational risk. But compliance can become a competitive moat by adopting RegTech workflows, standardizing ESG and reporting schemas, reducing audit friction, and speeding investor onboarding, which together lower costs, accelerate market access, and create a trust advantage versus slower peers. Winning FOFs rest on three strategic pillars: hybrid talent acquisition that blends data scientists with traditional analysts, incentive alignment that rewards predictive accuracy rather than just asset growth, and an adaptable API-YO-first tech stack that lets you swap modules as standards and tokenization evolve. Combined, these pillars enable a resilient, insight-driven organization that can adapt with the market. To navigate the future landscape, focus on 4 practical initiatives. Raise risk budgets to capture higher regrowth opportunities while recalibrating governance. Rotate 15-20% toward European capex cyclical and AII-adjacent mid-caps. Require managers to deliver machine-readable cash flow models for better forecasting. And negotiate co-invest rights tied to liquidity forecasts to protect downside and secure upside optionality.